This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%.
Warren Buffett's Berkshire Hathaway is holding an unprecedented $182 billion in cash. Why would the world's most renowned investor sit on such a massive cash pile unless he saw something troubling on the horizon? Is this a sign of an upcoming market crash? What does this mean for your investments? In this video, we'll look deeply into Warren Buffett's latest financial moves, analyze the indicators pointing to a potential market downturn, and explore how these could affect the average investor. Let's explore the reasons behind Buffett's conservative strategy and what it signals about the future of the stock market. Warren Buffett, known for his smart financial strategies, has recently made headlines with Berkshire Hathaway's enormous cash reserves, which have swelled to a staggering $182 billion. And the reason for this is not because he is a miser. Rather, this is a strategic move, as he explains in this clip.
That's a miser or a hoarder or anything like that in our group. They live very well. But the math of compounding and a long runway have done wonders, and we will talk a little later. Right before lunch, we'll give an illustration of that, of what can be done with that sort of philosophy. Our cash and treasury bills were $182 billion at the quarter end, and I think it's a fair assumption that they probably be about $200 billion at the end of this quarter. We'd love to spend it, but we won't spend it unless we think we're doing something that has very little risk and can make us a lot of money.
This figure isn't just a number, it's a signal. And understanding its implications require a look at the broader economic context and Buffett's investment philosophy. Historically, Buffett has advocated for holding cash during times of overvaluation to capitalize on market downturns by purchasing undervalued assets. This strategy of patience and precision aims to maximize long-term gains rather than short-term yields. The size of Berkshire's cash pile is particularly noteworthy because it deviates significantly from traditional operational reserves, suggesting a strategic preparation for purchasing opportunities that arise during market corrections. To understand this, let's have a look at this clip.
Stock is at a level where it adds slightly to the value when we buy in shares, but we would really buy it in a big way, except you can't buy it in a big way because people don't want to sell it in a big way. But under certain market conditions, we could deploy quite a bit of money in repurchases. And as you'll see on the...
This conservative stance might seem counterintuitive when considering the current returns from cash equivalents like short-term U.S. Treasuries, which are fetching about 5.4% in yields. Such returns are not negligible, especially in a low-interest environment. Buffett's decision to hold such assets indicates a preference for liquidity and safety over higher but riskier market returns. It reflects his assessment that the market does not currently offer opportunities that justify the risk, especially in an economy brimming with high valuations and speculative drive. Analyzing Buffett's approach requires understanding the function of cash in investment strategy. Cash acts as both a buffer against market volatility and a tool for capitalizing on new investment opportunities without the need to liquidate existing holdings at a loss. This strategic reserve allows Buffett, and Berkshire by extension, to act swiftly and decisively when the right opportunity presents itself. Moreover, the scale of cash holdings can be seen as a reflection of Buffett's outlook on the market's pricing and stability. A ballooning cash reserve in times of widespread market optimism often precedes financial corrections. Buffett's track record shows a pattern. He builds up cash when markets are robust and spends during downturns, a method that has sustained long-term growth and stability for Berkshire Hathaway. By maintaining a significant cash reserve, Buffett is not just preparing for a downturn, but also protecting Berkshire's assets from potential market devaluations. This approach highlights a fundamental investment principle. The preservation of capital is as important as the generation of returns. The immense size of this cash reserve is a clear indication that Buffett is gearing up for significant market movements ahead. And smart investors should take note of this strategy for its implications on both market trends and individual investment decisions. Warren Buffett has long utilized a particular metric to assess the overall health and valuation of the stock market, famously known as the Buffett indicator. This measure compares the total market capitalization of publicly traded companies in the U.S. to the nation's gross domestic product, or GDP. Currently, this indicator stands alarmingly high at 199%, almost double the GDP. This level is more than just a statistic. It is a clear warning of market overvaluation. The significance of the Buffett indicator lies in its historical accuracy in signaling economic bubbles. By comparing the stock market's valuation to the actual economic output of a country, the indicator highlights gaps between the price of stocks and the real economic value they represent. When the ratio exceeds its historical average significantly, it suggests that stocks are priced beyond what economic fundamentals would support. Historically, every time the market cap has drastically outstripped GDP to this extent, a correction has followed, aligning prices more closely with economic realities. Currently, the 199% of the Buffett indicator is nearly 2 standard deviations above the historical norm. This deviation is significant because a standard deviation in statistical terms is a measure of variance or dispersion around a mean. When a data point, in this case the market valuation, strays this far from its average, it indicates a severe anomaly that typically precedes a return toward mean levels. In other words, a market downturn. This phenomenon is not merely a matter of numbers, but reflects broader economic trends and investor behavior. When market valuations soar disproportionately to the GDP, it often indicates widespread speculative investing where the price increases are driven more by the investor sentiment than by company fundamentals. Such environments increase the risk of market bubbles as investors pay more for stocks not because of the intrinsic value of the companies, but because of expected gains from further price increases. The implications of the Buffett indicator at such high levels are clear. Investors are paying premiums for securities without corresponding increases in underlying economic output, making the market vulnerable to significant corrections. Buffett's reliance on this indicator suggests a cautious approach to investing in an overvalued market, where the potential for growth is overshadowed by the risk of a severe adjustment. Understanding and monitoring this indicator can provide critical insights into market conditions, helping investors make informed decisions about when to invest, hold, or divest assets based on broader economic signals, rather than short-term market fluctuations. For individual investors, this means that times of high Buffett indicator readings should be approached with caution, prioritizing asset protection and risk management over aggressive growth strategies. In the current economic landscape, interest rates and their relationship with market sentiments play a critical role in shaping investment decisions, particularly in the context of Warren Buffett's conservative strategy. The inversion of the Treasury yield curve, specifically the 1-02 Treasury yield, is a critical indicator that has been inverted for over 630 days, a historical anomaly. This inversion occurs when short-term interest rates exceed those of long-term bonds, suggesting that investors expect economic challenges in the near term, with more stability or growth in the long run. Understanding the significance of this inversion requires a basic grasp of what the yield curve represents. Generally, long-term bonds should offer higher returns to compensate for the risk of holding an investment over a longer period of time. When this trend inverts, it signals a lack of confidence in the near-term economic outlook. Market participants anticipate that the central bank might lower interest rates in the future to stimulate a slowing economy, which in turn increases the value of longer-term bonds retroactively. This sustained inversion of the yield curve has been a reliable recession predictor in the past. Historical data shows that every recession since the 1950s has been preceded by this phenomenon. The current prolonged inversion points to deep-seated concerns about immediate economic prospects, despite surface-level market optimism. It's a dichotomy that Buffett likely considers deeply in his investment strategy, reflecting his preference for safety and liquidity over higher yields that carry increased risk. Moreover, the current return on short-term U.S. Treasuries, around 5.4%, represents an anomalously high yield in what has been a low-interest environment globally. These yields have become attractive, offering safe and decent returns in uncertain times. Buffett's approach of maintaining substantial holdings in cash equivalents as opposed to investing in high-performing stocks or other volatile assets highlights a defensive stance with the objective of safeguarding capital in the face of economic uncertainty and market overvaluation. For individual investors, this scenario further emphasizes the importance of understanding broader economic indicators, and not just the headline figures of stock market performance. The yield curve and interest rate environment are crucial gauges of economic sentiment that can guide more informed, prudent investment decisions. They suggest that now may be a time for caution rather than aggression, aligning with Buffett's approach of waiting for clear signs of stability or an adjustment in market valuations before committing large capital outlays. These factors influence not only the decisions of individual investors, but also shape the strategic directions of large investment conglomerates like Berkshire Hathaway. Warren Buffett's investment decisions have always been a focal point for analysts and investors alike, not only because of his status as one of the world's most successful investors, but also due to his unique ability to foresee major economic shifts. Currently, his actions, or notable lack of actions, show his assessment of the market state. Buffett's historical approach and his current strategy provide insight into how he perceives today's market conditions. In the past, Buffett has shown a pattern of building up liquidity in anticipation of market downturns. For example, during the late 1990s dot-com bubble, Buffett was criticized for not participating in the booming tech sector. However, his caution was vindicated when the bubble burst in the early 2000s, and he was able to purchase valuable assets at a fraction of their cost during the downturn. Similarly, leading up to the 2008 financial crisis, Buffett's Berkshire Hathaway held sustainable cash reserves, which allowed him to make opportunistic buys when prices plummeted. Today, Buffett's Berkshire Hathaway is maintaining a cash reserve of $182 billion, a decision that mirrors his actions from previous market peaks. This is not merely a precaution, but a strategic position, allowing him the flexibility to invest heavily when prices are more favorable. This pattern of behavior is a clear indication that Buffett might be anticipating a similar market correction in the near future. His reluctance to invest heavily in what he perceives as an overvalued market aligns with his long-term investment philosophy. Be fearful when others are greedy, and greedy when others are fearful. Additionally, Buffett's current investment behavior shows a strategic restraint. He has trimmed positions in some major holdings and has not made significant new investments, despite the availability of cash. This is indicative of his assessment that the market is currently not offering the right value for the risk involved. Instead, he chooses to wait for a more attractive investment opportunity that meets his strict criteria for value. Buffett's approach also emphasizes a fundamental investment principle: the importance of not just where you invest, but also when you invest. Timing, driven by careful analysis and patience, is important to his strategy. This disciplined approach, waiting for the optimal moment to deploy capital, minimizes risk and maximizes potential returns. For individual investors, observing Buffett's current actions offers a valuable lesson in restraint and strategic planning. In a market driven by speculation and short-term gains, Buffett's focus remains steadfast on long-term value and safety. His actions suggest that investors should be cautious, particularly in a high valuation environment where the risk of the downturn could lead to substantial losses. Warren Buffett's current strategy might be conservative, but it's grounded in realistic views of market conditions and a profound understanding of economic indicators. As always, his moves are not just about preserving capital, but also about preparing to capitalize on future opportunities. What do you think about Buffett's strategy of holding such a large cash reserve? Do you see this as a signal to prepare for a downturn, or is it just smart asset management? Share your thoughts in the comments below. Stay tuned, stay informed, and remember to like, subscribe, and comment with your insights on Buffett's market outlook. Until next time, keep your investments smart and your portfolio strong.